Hey, I'm Felissa Rose, and you're watching Keto and Crime.
Oh, yeah, the almighty dollar. Something that us, especially people like me that are capitalists at heart, spend their whole life chasing. But as we all know, money isn't really evil. Money is just a way that we trade goods and services. In the old days, this was the barter system where you literally traded goods for goods, services for services. Goods for services, you get the drift. It was, somebody over here raised chickens. They traded eggs to somebody over here that had a wheat that they had wheat. Then they traded they traded something to the man that owned the wheat mill to mill the wheat, so on and so forth. That was the old way of doing currency, and currency simply became a way for the barter system to be, let's face it, regulated and, you know, standardized. And that's when we get into the whole debate about fiat money, which is our standard form of currency, thus the almighty dollar. Tracy, why are you babbling? Well, I just wanted to say that money or bartering or anything that you use to pay debts, public or private, is not evil. But it is the pursuit and the worship of that money that can become evil. And the institutions that we rely on the most to handle our money are often those that that perpetrate the biggest scams. I mean, we've already seen what happened with the fiasco with Wall Street bets, the hedge funds, and GameStop. Good knows we've seen a ton of Ponzi schemes on this channel, both religious and otherwise, but there are also scams perpetrated by your basic, normal, everyday banks on individual consumers like you and me. And what we're going to talk about today is something that happened with Wells Fargo in the mid 2000s. The Wells Fargo account scandal, where they literally signed up millions of people for accounts that they didn't consent to. Think it's not possible? Oh, it was. And let's add this to the long list of things that Wells Fargo has done, from mortgage fraud to everything else. But with that being said, let's dive into a Keto and Crime classic, the Wells Fargo account scam. Let's do it. Everyone, welcome to Thought Crime and Keto and Crime. Back with you today. Today we're going to be going over the Wells Fargo account fraud. For those of you that don't know, Wells Fargo got themselves into a spot of trouble back in 2013 for basically committing both identity fraud and bank fraud and wire fraud all at the same time. So we're going to get into that. I hope you enjoy it. Also, debuting my brand new microphone. I hope that there will be much fewer lapses in audio going forward. Definitely trying to improve the channel and the podcast bit by bit, so I hope you're enjoying the new camera and now the new microphone. But with nothing else, let's get started. Wells Fargo account fraud. For those of you that don't know, Wells Fargo had gotten itself embroiled in a couple of scandals during the financial crisis of 2006 through 2008 because of their mortgage department being heavily embedded in the subprime mortgage, which is basically loans made to people with what you would call subprime credit, below what the normal bank would loan money to. So they had gotten themselves into quite a pickle with that, and so decided to, instead of embracing new business and trying to expand into new endeavors, that they would just simply try to expand upon their current client base by getting their clients involved in more and more accounts with them. This is a popular Wall Street adage known as churn and burn. Basically, work with what you've got, make them buy as much as they can, and take your commissions off that. This all started as early as 2010 with the merger and acquisition of former Norwest Corporation officers. Norwest Corporation was a operation based out of Minneapolis, Minnesota. They initially merged in 1998, though Norwest was just kind of, it dissolved into the Wells Fargo model. But now they decided to actually take on some of the former Norwest protocols. Chief among them was the hiring of former Norwest CEO Richard Korovich, whose tactics at Norwest could be described as trying to get as much out of his customers as is humanly possible. In fact, there was a memo circulating through Norwest during his tenure there that basically said, we want a goal of at least 8 consumer products or accounts per Norwest customer. Now, the average in the industry at the time was 3. That means that most banks had an average of 3 consumer or products or accounts per customer. And that was actually pretty high, because I know I only have 2 products with Bank of America. I have my joint checking account with my wife. I have a credit card. That's it. That's all I have with them. But Norwest had a policy of trying to get people to open a checking account, a savings account, a CD, an investment account, a credit card account. Just mainly their goal was 8. And upon further research, the only background for the number 8 that I could find was in a obscure quote by Mr. Korovich himself, where he said, 8 rhymed with great, so therefore we decided that 8 would be the number we would shoot for.
Are you stupid or something?
So most records indicate that this brilliant policy was rolled out to Wells Fargo in about 2009. Now, first we have to understand the term cross-selling. Cross-selling is an industry term that simply means cross-selling to your existing customers. It's nothing unusual in the banking department. I've gone to Bank of America branches the few times a year that I actually go to a branch, and have been asked, would you like to open up another credit card today? How about a CD today? How about a savings account today? No, I just turn them down. But cross-selling to your clients is nothing unusual. But cross-selling on this broad scale was very unusual. This was rolled out to them in about 2009. And he set a goal, as I said, for 8 consumer products per customer. And in addition, he set some pretty stringent sales goals for all Wells Fargo employees. You basically had to sell 20 products a day. So every Wells Fargo branch employee was expected to cross-sell at least 20 products a day to existing customers. As you can imagine, those kinds of sales goals are absolutely unrealistic and hard to accomplish without doing things that aren't kosher or aren't on the level, so to speak. But in the first wave, employees tried to do it legitimately. They would legitimately try high-pressure sales tactics on existing customers to get them to buy something else. When that didn't work, they sought out their own family and friends, asked them to open up accounts, even if they never used them. And then once they had exhausted all of that, they simply decided, well, what a customer won't know won't hurt them. So they started looking in their own customer base and picking ones that had good prime credit, that is high 600s to 800s credit score, people that would automatically be approved for just about anything they could apply for. And they started applying pre-approvals to their accounts, and then took it so far as to start opening up credit cards, loans, and savings accounts in their name without their consent. Basically, at levels that were pre-approved, that is, they don't need an additional credit check. They've already done a pre-approval on them. So they basically started opening up these accounts in the names of their customers without their customers' consent. And how did they get away with this? Well, they did a variety of things. Some would use their own contact information, their own email and telephone numbers. They would invent phone numbers and email addresses. They would go to Gmail, Yahoo, AOL, what have you, open up new email accounts and use these emails as the point of contact for these customers. And they would spend their days, instead of doing their actual job, creating email addresses, coming up with phony phone numbers, and opening fraudulent accounts for their customers. And it worked because, of course, with these kind of tactics, they easily made it to an average of 8 products per customer. And their measure, which is an industry measure, that average is an industry measure, they exploded, as you can imagine, though it was all phony. Most of these accounts were never used, but it did make their numbers look really, really good. The customers would have their new debit cards for these accounts mailed either to the branch or to these employees' home addresses, and the employees would use bank software to actually set their PINs at 0000, so that there was never any indication when they had to call in to activate things and do things that they could get them activated. I can't even imagine the amount of effort it would take to do all that. To me, it seemed it would be easier to try to get these in the legitimate way, but their sales figures, 20 new products a day on average, that's 100 new products a week for each employee. There were some estimates that said in some of the smaller towns where Wells Fargo is located, they would literally have to sign up every single man, woman, and child in the town with an account to reach those numbers. That's almost impossible. And this was systemic. It came down from the top. The management kind of turned a blind eye to it. And at that time, they had a head of retail banking, Carrie Tulsit, who was actually found to be encouraging this type of behavior, even though there had been a few memos come down from higher management discouraging the practice. She was actually on record as saying, just ignore that. It's business as usual. Keep doing it. There were a few whistleblowers that started calling at the branch level, that started calling the corporate fraud hotline, reporting these sorts of things. They were kind of swept under the rug. In 2013, the Los Angeles Times ran a series of articles kind of lambasting Wells Fargo, as they had heard rumors of this sort of stuff going on, but it was all kind of swept under the rug until 2016, when the Consumer Financial Protection Bureau started a wide-scale investigation of Wells Fargo and then announced that it would be fining them $185 million for what it called grievous illegal activity. At this time, Los Angeles City District Attorney took over the case and started a formal prosecution of Wells Fargo within the state of California. And from here, the whole bottom fell out, and there were people they encouraged people to check their accounts, and people started noticing, hey, on my started checking their accounts, started checking their credit reports, and noticed, hey, I've got accounts here that I legitimately did not open up. What's going on here? I didn't open up this Wells Fargo credit card account. People started noticing, and the class action lawsuits started in mass. At the heart of these suits were a lawsuit by 3 former Prudential Insurance Company employees who were fired from Prudential Insurance in 2016 for reporting the fraud. Why? Because Wells Fargo had an agreement with Prudential Financial and Assurant, who were both licensed to sell insurance products, and they were actually Wells Fargo employees were actually signing up existing Wells Fargo customers for life insurance policies through Prudential and renter's insurance through Assurant fraudulently. And there were 3 underwriters from Prudential who discovered the fraud, reported it, and were later fired in retaliation. So they started filing suit, everyone else started filing suit, and eventually the federal government, led by a presidential candidate, Elizabeth Warren, got hold of it and started en masse prosecuting Wells Fargo.
What really gets me about this, Mr. Stumpf, if one of your tellers took a handful of $20 bills out of the cash drawer, they'd probably be looking at criminal charges for theft. They could end up in prison. But you squeezed your employees to the breaking point so they would cheat customers and you could drive up the value of your stock and put hundreds of millions of dollars in your own pocket. And when it all blew up, you kept your job, you kept your multi-million-dollar bonuses, and you went on television to blame thousands of $12 an hour employees who were just trying to meet cross-sell quotas that made you rich. The money that you took while this scam was going on, and you should be criminally investigated by both the Department of Justice and the Securities and Exchange Commission. This just isn't right. A cashier who steals a handful of 20s is held accountable, but Wall Street executives who almost never hold themselves accountable, not now and not in 2008 when they crushed the worldwide economy. The only way that Wall Street will change is if executives face jail time when they preside over massive frauds. We need tough new laws to hold corporate executives personally accountable, and we need tough prosecutors who have the courage to go after people at the top. Until then, it will be business as usual.
Initially, it was thought that 1.5 million fraudulent bank accounts, 500,000 fraudulent credit card accounts, and approximately 100,000 fraudulent life insurance and other insurance policies were underwritten by Wells Fargo from 2011 to 2016. However, in 2018, more were released, and we are thinking it's more in the neighborhood of 3.5 million fraudulent accounts, covering well over $100 million in fraud. Well, as you can imagine, Wells Fargo came under severe scrutiny and even had to testify on Capitol Hill to defend their honor. Former head of retail banking, Carrie Tolstead, took an early retirement in 2016, while CEO John Stumpf actually stepped down from being CEO October 2016. Roughly after the government initially fined Wells Fargo $185 million for illegal activity, they had to immediately close the fraudulent accounts, and in retaliation, Wells Fargo fired 5,300 bank-level employees, lower-level employees that had been ordered to do this fraud by higher-ups, while John Stumpf retired with a golden parachute. He did have to forego $42 million in stock options. Carrie Tolstead got her full retirement package and was never even clawed back, as far as we know. She didn't have to surrender anything, even though she was pinpointed as having ordered lower-level employees to mitigate this fraud, to do this fraud in order to meet unreasonable sales objectives.
Carrie Tolstead's retirement in July. As you know, Ms. Tolstead ran the community banking division, the division where this scam occurred, for the entire time that the scam took place. She was in charge of all of the 5,300 employees who were fired, and she oversaw the creation of 2 million fake accounts. Now, in July of this year, just 2 months before the settlement was announced, and before those facts became public, Ms. Tolstead retired at age 56. You indicated in the letter, responding to our letter, that she walks away with over $90 million in stock options, and awards. Fortune magazine says it's actually about $125 million. But, and here's the key part, according to Fortune, if Ms. Tolstead had been fired instead of retiring, she would have had to forfeit as much as $45 million of that award. Mr. Stumpf, the response to our letter confirms that you knew of this scandal before Ms. Tolstead retired. It said, and this is from your letter, quote, senior management and the board were aware of the pending litigation, investigation, and discussions with our regulators relating to sales practices when Ms. Tolstead indicated her decision to retire. Is that accurate, Mr. Stumpf, what this letter says? Were you personally aware of the massive problem that occurred under Ms. Tolstead's watch in July when she announced her retirement?
I was aware of that. We were involved in discussions with the city attorney, the OCC, and the CFPB, yes.
So you had some indication there was a massive problem.
We had some indication that we had 1% of our people who were doing the wrong thing.
Also known as a massive problem.
Well,
if you knew this, did you consider firing Ms. Tolstead before she retired?
well, at the time, she was reporting to our president and chief operating officer.
It's a simple question.
No,
you knew there was a problem. Did you consider firing her?
No, because of her full...
Seriously? You found out that one of your divisions had created 2 million fake accounts, had fired thousands of employees for improper behavior, and had cheated thousands of your own customers, and you didn't even once consider firing her ahead of her retirement?
In fact, when I look at her full body of work, and I look at the customer loyalty improvement and the customer service improvement...
Are you sure that those were not fair?
Many of the class action lawsuits were settled, and Wells Fargo ended up refunding people as follows. They refunded $6.1 million in customer refunds to settle the fees and charges they were assessed for these fraudulent accounts. Like many of the credit cards carried yearly fees that were charged to those accounts. Those accounts, because they weren't being used or paid, were turned over to collection. So you had customers with collection reports on their credit reports. So they had to settle $6.1 million there. They had to settle $142 million to the class action lawsuits themselves. They then had to settle a $480 million for misleading shareholders because their stock was inflated because of these great cross-selling numbers. So they ended up having to pay back $480 million to their shareholders, and they had to pay roughly $575 million to settle lawsuits filed by around 50 states' attorney generals, as well as the federal fine of $185 million. So, as you can see, the total settlement that Wells Fargo had to pay out in its subsidiaries was about $3 billion for this fraud. And many, many people lost their jobs. So, what's the bottom line? Big banks, unfettered, will do bad things to ordinary people. And I think what's really telling is that the higher-ups that were really responsible for this got out almost unscathed. The very woman that actually set this in motion or helped get this in motion never had to pay a penny back of her retirement. She got out with her full retirement. In fact, Senator Elizabeth Warren really came down on the CEO at the time for still praising her for a job well done and not asking her to surrender a penny of her money. She also hammered him for not taking any personal responsibility for the fraud. So I think that's telling of some of these higher-ups that are in power. Not all corporations are bad. I think we know that. But unfettered, they will do bad things. I am a pure capitalist. I believe a free market is the best way to go. But I also believe that it can't be totally unsupervised, totally unregulated, or this kind of stuff happens. So we do need some controls. And that's the reason I think a more in-the-middle, moderate approach is good when it comes to the free economy. What do you think? Were you affected by the Wells Fargo scam? Do you know anybody that was? Anyway, these numbers are still ongoing. The last estimate about how many people had actually been defrauded, how many actual accounts came out, 2017, a full year after all of this was settled. So it may be getting into 6 or 7 million fraudulent accounts before it's over. Right now it stands between 3.5 million and 4 million. So I don't know. I think it's going to get a lot higher before it's all over. But bottom line, people, pull your credit bureau report. Know what's going on. Don't sign anything unless you really want to, because this is the kind of thing that can happen. Anyway, guys, I hope you enjoyed this. I'll be back soon. Sunday, I'll be back with another true crime video starting the Diane Downs case. So I wanted a nice little white collar video to kind of cleanse our palates before we go knee deep into another murder case. So looking forward to that. I hope you'll watch. If you want to support the channel, links are down below. Never required, always appreciated. Thanks a lot, guys. Comment, like, share, subscribe. Keto Comic out. And wash your hands, people. Coronavirus is not as bad as they're saying, but wash your hands, people. That's just good practices. Thanks a lot, guys. Keto Comic.